Good afternoon, everyone. 3 months ago, the MPC said that an ongoing tightening of monetary policy over the next few years would be appropriate to return inflation sustainably to its 2% target. That guidance was explicitly conditioned on the economy evolving broadly in line with the committee's February inflation report projections. In the period since then, the economy hasn't fulfilled those conditions. Growth at 0.1% in the first quarter of this year was much weaker, and inflation at 2.5% in March was notably lower than we had projected in February. The key question is whether this softness will prove temporary or persistent. In other words, was the weakness in the first quarter due to the weather or the climate? The MPC's central assessment is that it largely reflects the former, and that the underlying pace of growth remains more resilient than the headline data suggest. The period of adverse weather hit construction particularly badly, and it weighed on activity more broadly as people struggled to work and to make it into the shops. In contrast, the labor market has remained reassuringly strong. In the 3 months to February, employment rose by more than we had projected, and the unemployment rate fell to 4.2%, the lowest rate in over 40 years and a touch below the MPC's estimate of the natural rate. Private sector wages have picked up. Adding to the positives, job-to-job flows are back to their pre-crisis averages, and there's widespread evidence in employment surveys of a tightening labor market. The overall economic climate in the UK looks little changed to the MPC thus far. In particular, we have long forecast a rotation in demand towards net trade and business investment and away from household consumption. This is what has happened, and we expect it to continue. UK exporters remain in a sweet spot, with sterling down 15% in anticipation of a Brexit that has not yet happened, particularly with a new transition agreement that extends unfettered access to EU markets until the end of 2020. Although they've eased slightly, the European and global economies are growing faster than trend and are projected to remain robust over the forecast period. As a consequence, net trade is projected to continue supporting UK growth over the next few years. Turning to business investment, evidence of both the bank's decision-maker panel of 3,700 firms and our direct contacts across the country indicate that the drag from Brexit uncertainty, while persisting, has not intensified. With continued support from strong external demand, limited spare capacity, the relatively high rates of return on capital, and the low cost of finance, business investment is expected to continue to expand at a moderate annual rate of around 4% over the forecast period. On the consumer side, although there's been some reduction in the household savings rate since the referendum, this has been far from a debt-fueled consumption boom. Rather, household spending has broadly tracked income and employment growth. There is somewhat greater uncertainty about the near-term momentum in consumption spending, given the recent weakness in consumer credit and the housing market, with the possibility that households could opt to save rather than spend as their real incomes recover. On balance, though, with the real income squeeze coming to an end and the adverse weather behind us, consumption growth is projected to recover over the forecast to rates broadly in line with the subdued pace of real income growth. Let's put that in some context. The MPC is expecting household consumption to grow over the next few years at about only half the rates prior to the referendum and merely 1/3 of the rates prior to the global financial crisis. So overall, the climate is one of modest demand growth, with a combination of solid growth in net trade and moderate growth in business investment, offsetting more subdued growth in household spending. These judgments leave the MPC's latest projections broadly similar to those published 3 months ago. In particular, GDP growth is projected to pick up after the weak first quarter to annual rates of around 1.75% throughout the forecast period. Now, a critical judgment by the MPC is that such modest growth by historical standards is still likely to be sufficient to exceed the expected 1.5% average annual growth in the economy's supply capacity. That diminished rate of supply growth reflects the climate of the past few years, with the shallowest investment recovery in half a century, lower growth in labor supply, and modest productivity growth. With very little spare capacity remaining in the economy, and with growth in demand outpacing that of supply, a small margin of excess demand is projected to emerge by early 2020. As a consequence, domestic inflationary pressures are expected to continue to build gradually to rates consistent with the 2% inflation target. That offsets a waning contribution from import prices, so that inflation falls back over the year to settle at the 2% target by the middle of 2020. Let me expand on that for a moment. Although CPI inflation has fallen back by more than we had expected at the time of the February report, that shortfall largely reflected lower than expected inflation rates across a range of import-intensive CPI components. Since sterling's depreciation following the referendum, import prices have risen by somewhat less than the MPC had been expecting, with pass-through from sterling world export prices currently running at around 50% rather than the anticipated 60%. And in previous reports, in previous projections, all of that gap between 50 and 60% was projected to be made up over the course of the forecast period. But with more signs that that isn't happening, the MPC judges that now only about half of that shortfall will come through. In contrast to the external side, domestic inflationary pressures have been strengthening as we anticipated. As we had projected in February, regular pay growth has risen to just under 3%, and unit labor cost growth has firmed over the past couple of quarters to rates consistent with the 2% inflation target. Other measures of domestically generated inflation have also moved closer to their target consistent rates. Turning to policy, in the exceptional circumstances prevailing since the referendum, the MPC has set policy to balance the trade-off between the speed at which inflation returns to target and the support that monetary policy provides to jobs and activity. That policy is working. Employment is at a record high. Import price inflation is fading. Real wages are rising. And domestic inflationary pressures are gradually building to rates consistent with the inflation target. The steady absorption of slack over the past year and the prospect of excess demand over the forecast period have reduced the degree to which it's appropriate to accommodate an extended period of inflation above target. As a consequence, the MPC began to remove some of the stimulus that monetary policy has been providing, raising bank rate to 0.5% in November. At its May meeting, the majority of the committee judged it was appropriate to maintain the current accommodative stance of monetary policy. But if the economy evolves in line with the May inflation report projections, the MPC judges that an ongoing modest tightening of monetary policy over the forecast period will be appropriate to return inflation sustainably to its target at a conventional horizon. As was the case before, that judgment relies on the economic data being broadly consistent with the MPC's projections. And as has long been the case, the MPC expects that any future increases in bank rate are likely to be at a gradual pace and to a limited extent. While the storms of February and March have given way to sunnier skies, the economic outlook for the UK remains clouded by Brexit uncertainties. Despite the welcome agreement on a transition period, the terms on which the UK will trade with the EU beyond that period remain to be determined. As negotiations progress this year, the medium-term economic climate will become clearer. As it does, households, businesses, and financial markets will adjust. The MPC will monitor these developments closely and react as appropriate to ensure that inflation returns sustainably to the 2% target, consistent with its remit. And with that, Ben, Dave, and I would be pleased to take your questions.
Okay, as always, can you please give us your name and the organisation you represent, and please keep to one question each, at least for the first round. Ed and then Jill to begin with.
It's Ed Conway from Sky News. Governor, in markets there is still some confusion and consternation about how people can prejudge what decisions the Bank of England is going to make. Can you be clear about what rationale was going on in this decision? Because you've talked in the past about people needing to focus on the data, but then you've said actually this very weak first quarter GDP print actually might be kind of overstating the contraction. So should they actually be focusing on the data, or should they be trying to prejudge your judgment on the data? Things are getting confusing for people out there.
Well, let's say first thing, people we speak to first and foremost are households and businesses across the country. And if you look at surveys of households, like the HFI survey, if you look at the most recent Deloitte CFO survey, if you do the surveys and the meetings that we do with businesses and meet with consumer groups across the country, the expectation of those individuals, more than 3/4 of those, whether they're individuals or businesses, is that interest rates are going to go up, are likely to go up at some point over the course of the next year, probably a couple of times over the course of the next year, year and a half. Okay? So they are in a position that they can plan accordingly for that possibility. They don't think it's a guarantee. They think it's a likelihood. You would also, if you meet with households and businesses as you do, know that they think that we will react accordingly to the underlying conditions in the economy. So first point is, who do we speak to? First, we speak to the people we serve, which are directly households and businesses. The second is that the judgment about the stance of policy, to get into the technicals, relate to the balance of supply and demand in this economy. Now, we have been as clear as we can be, I think, about where we think the rate of supply growth is in the economy. We've given a figure for the natural rate of unemployment. We revise that, we update that once a year. We've updated to 4.25%. We've given a view on what the rate of potential growth is, or the speed limit of the economy, about 1.5%. And we've also given a view about the overall level of slack, which, as of today, we view as very limited in the economy. And so the question is, which one can't prejudge, one can have an opinion on, but one can't prejudge, is how fast is this economy going to grow relative to that speed limit? We can't guarantee an outcome for economic growth. It's affected by a variety of factors, both external and internal. But you can make a judgment that if the economy is growing faster than the speed limit, it's likely, certainly our view, that domestically generated inflationary pressures are going to continue to pick up, and that consistent with that, some withdrawal of monetary stimulus would be required. Now, people in financial markets, there's a lot of people in financial markets, they will have a range of views about the likelihood of that. It will be influenced by their views of the European economy, by their views of animal spirits and businesses, potentially of their views of likely outcomes of Brexit negotiations, potentially all of the above. But if they can form a view of where they think the economy is going and update that view as the data comes in and what it informs, then they can make a judgment about what we're likely to do. Now, last word on this. Probably won't be the last word, but the last word for your response to you. In terms of the decision at this meeting, we had data come in lower than our expectations. It was mixed. There was some stronger data, but on balance, it was mixed and weaker. And certainly the hard data, the ONS data, was lower than expectations. In a world where you're looking at limited and gradual rate increases, you sit down and say, I think the most likely thing is that the underlying momentum in the economy is still there, above that modest hurdle that I described, the 1.5 percentage point speed limit of the economy. We think it's still there. That's the view of the committee as a whole. That's what's in our projection. But what's the sensible thing to do? Do you act now, or do you wait to see evidence that that momentum is reasserting? The judgment of the committee, of the majority of the committee, is you wait to see for some evidence of that reasserting. Now, the market And those who follow closely what we do can make their own judgment about how likely that is. And they will update those views as information comes in. For households, businesses focused on other things, they have, I think, well, we know as of now, the general orientation, which we're confirming today, that interest rates are likely to go up to a limited extent and at a gradual pace, and they should plan accordingly.
Jill Ward, Bloomberg News. Perhaps an elaboration on that question. As of 12:14 or so, money markets have...
Sorry, can you just, Jill, I'm having trouble hearing you, so.
May switched on the mic.
If you shout it out, I'll repeat it. How's that?
Sure. As of 12:14 or so, money markets have priced out a rate increase this year altogether. Are you happy with that? Having seen the inflation report, it comes across, for lack of a better term, as a hawkish hold.
First, I'm not sure that's right, what you said, the premise to your question. I'm afraid to challenge, yeah.
If you mean it's not 100% priced,
Yeah,
maybe, but it's, I think there's a sort of 85% chance by
Sure.
November.
I mean,
So
we speak,
they haven't
just to be
priced it
clear,
out.
in my answer to Ed, we speak first to households and businesses in the country, but we also pay attention to what's going on in financial markets, and I know where the OIS and SONIA curves were before I walked in here. So, look, this goes to the core question, though, which is stance of policy. And I won't repeat all of the answer I just gave, but the orientation of policy, the view of the committee as a whole, is that we think the momentum in the economy is going to reassert. Now, this is not an economy that's growing at robust rates, but we expect it to reassert at rates that are stronger than the rate of growth of the supply capacity of the economy. That will continue to build domestically generated inflation, which will be increasingly important to the inflation profile as imported inflation, the imported inflation from the past depreciation of sterling, as that comes off. Again, between now and the next meeting, between the June meeting in August and on through the year, there'll be a series of data, series of things will happen in this economy and the global economy, and people will have to update their views on the likelihood that the economy will evolve in that direction. Our view, sitting here today, is that there's reasons to think that it will reassert. Others can have a different view, and they can trade or invest accordingly. But if we're right, if things transpire in that direction, then the expectations of households and businesses in this country, which is for some modest adjustment of interest rates, will be justified.
Okay, Kamal and then Helia.
Kamal Ahmed, BBC. Governor, how worried are you that the tag of unreliable boyfriend sticks? That households and businesses listening to you in February took the clear signal that interest rates were going to rise more quickly and to a greater extent than previously thought. They will listen to you today and say, oh, no, interest rate rises are now off for a longer period this year. Can the audiences and the households and the businesses that you're so keen to speak to trust what you say about whether interest rates are going to go up, and more importantly, when that is going to happen?
Well, first off, Kamal, the households and businesses we speak to don't trade short sterling, okay? They're not fixated on whether we raise interest rates on May 10th or at the end of June or in August. They want to know, first and foremost, what they want to know is the general orientation of the economy. That's really what they want to know when we go around the country and speak to them. Entirely understandable. Their jobs depend on it. Whether they make an investment depends on it. These are fundamental issues, and that's the first and foremost thing they want to understand. The second thing they want to understand still is the financial system healthy? And is the financial system in a good position for the potential shocks we could get from the variety of headlines that are on your network, geopolitical issues, European issues, et cetera. And then the third thing is what's going to happen to interest rates. And of course, they're interested in what's going to happen to interest rates. Now, knowing the general orientation of policy, that those interest rates are likely to go up. They do know that. They do have that sense. And, you know, slews of surveys and series of meetings tell us that. But they also expect that if the situation changes, that they expect us not to be on some preset course. They expect us to be prudent, not passive. So if the situation's appropriate, we will adjust policy. And I'll say the only people who throw that term at me are in this room. So now everyone else can throw it at me when I go out of this room.
Channel 4 News. You're trying to give clear guidance.
And Pat McFadden, I should say.
You're trying to give clear guidance, but it ends up being confusing, and all jokes about being an unreliable boyfriend aside, why is the Bank of England struggling so much to help consumers understand what's coming? Or do you think you're doing a good job at communication?
Well, I think in terms of the overall guidance that we've given, the first was, if you go back 5 years ago, we're not trigger happy on interest rates just because the recovery has finally started. I would remind, finally started in 2013. We're not going to instantly raise interest rates. And we're going to wait until we see some progress before we even think about it. That message landed, okay? And that message, you can debate how much of an effect it had, but it didn't hurt in terms of business activity, in terms of people spending, in terms of the housing market, other factors. Subsequent to that, we tried to get across something which is now absolutely conventional wisdom, which is that longer-term interest rates are going to be lower for much longer than anyone had thought. We started talking about that in 2013. We have talked about it consistently, limited and gradual. I know you're bored with it, but it's important, and people are making decisions on the basis of that. And I think now, if you look back over the course of the last several years, that has been right. It has been right. It is part of the reason, it's not the sole reason, but it's part of the reason why we have the employment outcomes, we have the growth outcomes, and we have the inflation outcomes that we have. It's been necessary, and we still think that it's appropriate. Now, it is useful information for people to have that perspective. I do think, the committee does think, that it is still useful, and it's informed by discussions with businesses and households across the country. It is still useful to give an orientation on policy. Now, the UK economy is in a different, and I'll finish with this, we're in a different place, not surprisingly. It's a reason why we have an independent central bank. We're not in the same place as Europe, which has still a lot of spare capacity and a financial sector that has only recently recovered from the crisis. Fixed ours a long time ago. We have very little spare capacity in this economy in terms of the labor market, and relatively little in firms, and not big investment that's building that spare capacity. So we're in a different place from Europe, but we're also in a different place than the United States, which doesn't have a major trade set of discussions. It has some trade discussions, but not on the same order of magnitude or time frame or materiality of Brexit by any stretch of the imagination, and isn't in fiscal austerity but is in fiscal expansion. So you have to set policy to the circumstance here, provide the guidance, and I know it's not what you necessarily want to hear, but in terms of it getting through to those who make economic decisions in the country, it does.
Chris, and then Larry.
Chris Giles, Financial Times. One of the reasons people might be a little bit confused about the bank's stance is that you've said today that Q1 was erratic, an outlier. This wasn't an important slowdown, it was temporary. You've also said that the economic momentum is the same as you thought it was in February, and yet the path of interest rates you're sort of guiding on is significantly lower. In February, you're saying everything's the same. In February, you were being pretty hawkish and saying that financial markets weren't expecting sufficient interest rate rises, and now you're basically saying it's okay. This is why people are confused. And could you clarify that, please?
Okay, so there's a couple important things embedded in that question. Let me go to the last bit, and then I'll come back to the first, which is what we said in February. And what we said in February was a market message, and was a market message relative to November. So if you recall that the market curve we used for our November forecast had 2 rate increases over the course of 3 years. What we said in February is that relative to the November forecast, you needed more sooner and more. It happened to be more or less consistent with where the market curve had been moving. It was directionally moving. The market was moving towards 3 rate increases, and certainly the mindset of the committee was moving in that direction. Now, as we come in to this meeting, reminding you, and I apologize for being technical, but this is easy for you, we use the 15-day average of the market curve. The one we've used for this, it's mechanical, as you know, has 3 rate increases over the course of the next 3 years, as noted in the minutes. So there's no, it's the same, in effect, it's broadly the same curve as we were talking about in February. But why is inflation coming back to target sooner than we had expected before? From our perspective, from the view of the committee, it's not because of the weak Q1. It's because we've been accumulating evidence on the pass-through from sterling's depreciation that has indicated to us, and we've taken the judgment, that we're not going to get as much of that pass-through into import prices as we previously had thought. It's the 50-60% point I made in my opening remarks, and it's detailed in the report. And it had been flagged in previous minutes that we've been thinking about this issue. And that's why inflation comes back to 2% in 2 years' time, because we get a shallower path of imported inflation from the past depreciation. What hasn't changed is our view in terms of the building of domestically generated inflationary pressures, unit labor costs particularly, other indicators, which have come in line with our previous expectations, if not slightly firmer. So, and those are the elements that become increasingly important. But given what's happened on the external side, that combined with the weak first quarter means it makes sense to step back, say, okay, let's see, we think momentum is going to be reestablished. Let's see that momentum let's see evidence of that before moving.
Larry. Larry Elliott of The Guardian. Can I just follow up on that? Because in February you did say that you thought monetary policy would need to be tightened somewhat earlier and by a somewhat greater extent. You've now dropped that language. You're talking about an ongoing tightening of policy, which is much softer language. I'm not quite sure why.
Larry, I'm sorry, I'll give you another question because it's a curve versus curve point. It's a really technical point. I apologize it is, but it's in February talking about a curve in November that had 2 increases, having a curve with 3 increases. Now the curve we've used in the May report has 3 increases. So one doesn't send a signal relative.
You don't think that your language has been
regular pay, which we look at regular pay.
Thank you, Governor.
Phil, and then David behind.
Phil Aldrich at The Times. You talk often about rate rises being gradual and limited, or monetary policy tightening being gradual and limited. I just wondered why QE is not part of this this formulation, because obviously a very gradual and limited approach to tightening would be to just let the stock of gilts run off and mature, and it doesn't even seem to be discussed. So just wondered if you could expand on why not.
Yeah. As you know, the committee has given past guidance on on QE and preference that, an express preference that bank rate would be the marginal rate of, or the marginal tool, sorry, for affecting monetary policy. So having enough room to move bank rate in either direction as the inflation target required. Now, in due course, we will revisit that. That's not a big signal, by the way, but in due course, we'll revisit that and think it through. I think we also take, it would be prudent and appropriate to take careful observation of the quantitative tightening that the Fed has embarked on and the impact of that in making those judgments. A material change certainly benefit from the additional time and I think provide an added incentive, whatever happens in the end state negotiations, if I can put it that way, whatever happens in those negotiations, an added incentive for both the EU 27 and the UK to ensure that there is a transition period.
Tim and then Ben.
Thank you. Tim Wallace at The Telegraph. Governor, to ask about how this all feeds through to the real economy, your table on page 9 shows that interest rates paid by more...
Gives us time
Okay,
to
sorry,
read
I'll speak
page
up a bit. Tim Wallace at The Telegraph. To ask about how rates feed through to the real economy, your table on page 9 shows that rates paid by mortgage borrowers are rising a lot faster than rates paid to savers, which makes it look like banks are benefiting more than anybody else from this process so far. Is that fair? Are banks treating their customers properly, and is that the way you expect the rate rise process to go?
Let me I'll just headline, and then I'll pass to Dave Ramsden to expand. Headline consistent with historic experience, first point, and then secondly, we have to recall that one thing that's happened in the past as rates went down is that the spread between where the bank rate was and deposits compressed. And so the question is, as they go back up, what happens? But maybe, Dave, if I pass to you to expand.
I mean, this is, on the deposit side, this is, as the Governor just said, a trend that we expected, in the sense that the line we show on page 9 for instant access savings, typically you don't get full pass-through. Instant access savings are also where the majority of savings are, but you typically don't get full pass-through. And we're not in typical times because we've been through this period with very low bank rates. So normally deposit rates would actually have been below bank rate. But in the period of very low bank rate, they've actually been slightly above. Then in terms of the longer term savings products, there are more idiosyncratic things going on. But the key point is you never get full pass-through for sight deposits.
Governor, a question about business surveys. In Washington last month, you gave an interview in which you noted that some business surveys had come off, as you put it.
Yeah.
And yet the thrust of a lot of these documents today is emphasising the relative strength of the business surveys, certainly as a reason why we should look at them rather than the hard data. Yeah. Fairly or unfairly, that might be the kind of messaging which contributes to a sense of confusion. So, in markets, so could you take this opportunity to perhaps tell us which business surveys you at the bank and you personally put a lot of weight on, and which perhaps you disregard? Because clearly it's important for us understanding how you look at the evolution of the real economy.
Yeah. I think let me say a couple things. I'll pass to Ben. Look, we had a sense that the data was mixed. Proved that sense was correct. That Q1 was going to come in more softly, not point estimate in that regard, and a combination both of the SIPs and the bank's own agents' work, our own conversations gave us a bit of that. Also aware just that there were some things happening in the economy that might, or at least in the meteorologically in the economy that might be consistent with that as well. Plus some of the surveys internationally that also showed a bit of softening. Then the question becomes, what happens to them subsequently? How do you interpret? What should one expect? How do you interpret it? And how much a steer you take? You can take a steer on direction, but how much of a steer you take on magnitude and persistence of those shifts. And Ben, if you want to.
No, the only thing I wanted to point out, I think, Ben, you said that you pointed out, we said two things. One's that the surveys have come off, and two, that they're nonetheless consistent with rates of growth faster than the preliminary estimate for Q1. There's no contradiction at all between those two things. They were at higher levels. They've come down a little bit, but they're nonetheless consistent with growth much stronger than 0.1. And the same is true in parts of Europe. The only other thing I was going to observe when it comes to effects of weather is that you've seen similar patterns in other countries affected by unusually poor weather in the early part of the year. Equally, in places where you haven't seen very poor weather, US, Spain, Asia, you haven't seen growth weaken. So I think we have various things that suggest to us that this may overstate the underlying position of the economy, including those surveys, which, as I say, even if they're at slightly lower levels than they were before, do not point to anything like as weak as 0.1.
Sylvia at the front here, and then Howie at the back.
Sylvia Borelli, Politico Europe. Just a follow-up question on Brexit. I was wondering how a hard Brexit scenario would impact your forecast. The National Institute of Economic and Social Research last week said it expects a mild recession within the next 12 months if the UK and the EU end up trading under WTO rules. I'm just wondering if the bank has come up with any models or...
Right. Well, it would change our forecast. I think that's the first thing I'd say if we had a hard Brexit. But what we do is we manage monetary policy for the most likely outcome, so-called central expectation. We haven't included in that weighting a hard Brexit tail. So we're managing to a situation where we have made an assumption, two assumptions: one, the smooth transition, and secondly, to an average of outcomes, which runs between a WTO outcome, but not a disorderly move to a WTO outcome, but a WTO outcome to a relatively close economic partnership. What we've taken from the transition agreement is that the timing of that transition is actually pushed off the page. Our forecast goes out to the middle of 2020. The transition period goes out to the end of 2020. So the actual point at which the adjustment starts to happen goes beyond the forecast. That has some minor implications for the rate of export growth and import growth, not minor if you're an individual exporter, but from the overall economy, minor, because the two effectively balance out in the forecast. Where the bank has given done more work and taken more action around a hard Brexit has been the FPC, so the Macroprudential Committee of the institution, where we, with the regulator, the PRA, have run stress tests whereby the macro scenario, the impact of both the macro scenario, 4.5% recession, big fall in the exchange rate, big rise in interest rates, big rise in unemployment. That was actually motivated by different events, but those orders of magnitude, plus some other direct hits to bank capital. That was bigger in terms of the impact on the core of the financial system than our judgment of what a hard Brexit, a hard disorderly Brexit, to be clear, disorderly Brexit is key, would do to the UK financial sector. And we've made sure that those institutions are well capitalized to that worst scenario. So that's the way we've addressed it. We're not going to put out a forecast of various medium-term economic outcomes. That's that's the responsibility of the government if they so choose.
Okay, Harry at the back.
Good afternoon. Harry Daniels from Live Sport News. I want to get back to the question in the messaging, really for the markets predominantly, because that's the sort of audience we look at, and the timing of any communication that you give, as in the BBC interview you gave a couple of weeks ago ahead of the GDP. You kind of answered half the question when you said that you look at a range of survey data as well as hard data, but you didn't have GDP at your fingertips at the time, and yet you were still happy to point to a lesser likelihood that we'd see a rate rise in May. So it's really just what's the thinking behind the timing of your interview at the time, and also actually more specifically the timing itself in terms of after 6 o'clock when markets are shut, and the reaction the next day was a gap in market opening, and how that affects pension funds and the way they price things.
A couple of things. One, there were markets open at the time. They just didn't happen to be in London. Well, sterling is, cable is, it's a reserve currency. It's part of the SDR. It's traded 24/7. I mean, the markets are open, first point. Second, the timing of interviews, the timing of interactions, there are big blocks of my time, of Ben's time, of Dave's time, where we are in blackout or purdah, so we can't give a speech, we can't give an interview, we can't meet with certain businesses. When we are not in those situations, and by the way, we're in purdah for FPC as well as MPC, and sometimes I'm in for FSB and for various acronyms. Times when you can't speak. So when you have a window, then you fulfill your responsibilities accordingly. Giving an interview at the IMF's about the state of the global and the UK economy is an entirely natural thing to do. It goes back to tracking where different people have different views on where the economy is going to. I mean, as we sit here today, in this room, in investment managers and trading floors, businesses, others will have different views on the underlying momentum of this economy. Is it going to pick back up? And even if they have the same views, which they won't, there'll be a range of views on that, and that's appropriate. They might have different views on what's going to happen in the Brexit negotiations and whether that's going to reinforce the momentum or knock it off. And if they want to bring it into how that affects the stance of monetary policy of the Bank of England, we have an orientation, we have a forecast where if the economy is growing faster than the rate of growth of supply capacity, it is more likely than not that there'll be some withdrawal of monetary stimulus. If it's growing less rapidly, it's less likely to take the case. In the end, if you're in a world where you have limited and gradual rate increases expected over time in order to keep inflation at target, you have some flexibility on the timing of when you do those, and you need the mass of the committee in order to come to a view that it is the appropriate time.
Okay, Kiko at the front, and then back.
Hello, Kiko Konishi from Kyodo News. Question to Governor. Could you clarify the word you use, conventional horizon? You use the forecast period, which I understand is 3 years.
Yeah.
Is 2 years the conventional horizon? And is it something that you're shifting? Is it getting more important?
Yeah.
Thank you.
Okay, thank you. Important question. Yes, forecast period is 3 years. We forecast out 3 years. And the conventional horizon, the way we think about it, and Ben can expand on this, the way we think about for monetary policy is that given the impact of our actions, we change interest rates, quantitative easing, the impact of those, some of it feeds through relatively quickly, a lot of floating rate debt in this country, so if you've got a floating rate mortgage and we change bank rate, yeah, your payments change, but some of it takes time as things reprice and to have an impact. But think 12 to 18 months in terms of kind of full impact of transmission of a monetary policy decision. It's not an exact science, but think that. And so that means that sort of in that 18 to 24 month horizon, as you can bring inflation, underlying elements that are determining inflation, broadly back to target on that horizon, okay? So that's the more conventional horizon. Think 24 months for shorthand, okay? The reason we've made this point and been making this point successively in the last few inflation reports is that when we had the referendum, the big fall in sterling, we expected a couple of things were going to happen. One was that sterling was going to, and we said it in advance of the referendum, we thought sterling was going to go down sharply. We thought inflation would go up. And our challenge would be how much support to provide to the economy as inflation brought back to target. And under our remit, under our mandate, we have a responsibility if there's a so-called trade-off with inflation above target and underneath to be explicit about over what horizon we bring output or growth back up and inflation back to target. And so we explicitly move beyond a conventional horizon, beyond 2 years, to the end of the forecast. And we have published, and I published in a letter to a speech, but also a letter to the Chancellor, how that trade-off has evolved over time. Now, the story is now, it was almost there in February, it's basically there now, which is we have very little spare capacity in the economy. We have an unemployment below its natural rate. So we no longer have a trade-off. We're moving out of this world with a trade-off. And so the horizon over which we're bringing inflation back has moved from the end of the period to the more conventional, and actually, as the committee said in this, to a conventional horizon. And that's important for the stance of monetary policy. So even in a world where you have less pass-through, we're putting more weight on getting inflation back to target at 2% at the 2-year horizon. I don't know if we want to talk about
really nothing to add except to remind you that that's what our remit explicitly asks us to do, that when we have a shock that can push output and inflation in different directions, like a big exchange rate change, the remit asks us to explain to people, first to make a judgment about how quickly to bring back inflation. We could do it earlier, but we have to take a view about how much damage that might do to output. And secondly, to explain that. And it is quite important, therefore. People sometimes are tempted to look at a particular point of our inflation forecast and say, well, that's all I need to know to tell whether the MPC is inclined to push interest rates in this or that direction. But it does depend critically on the context. And so we've been at pains to try and point out that as this pressure from import prices fades, when the horizon over which we would hope to bring inflation back to target is coming in.
Okay. Last question from Matisse at Black.
Hi, my name is Matthijs Schiffers from the Dutch Financial Times. This week, the Office for National Statistics has lowered the UK trade deficit with a staggering 25%. So I was wondering how reliable are all the data we're talking about all the time, and how reliant is the UK on the kindness of others, as you've pointed out before?
It's a great question. Yes. Ben, you would like to?
Yeah. Governor, on the kindness of others. The early estimates of many of these things need to be treated with a degree of caution. We've been talking a lot, for example, about GDP. In the first quarter of this year, we have one estimate of that. We can be fairly confident that's going to be revised. I just took a look before I came in at other quarters we've had in the last few years where we've had unusually high levels of snowfall. The average revision to estimates of construction growth in those quarters is over 4 percentage points, always upwards. So one has to treat all these numbers with a degree of caution. That's why one of the reasons why we also look at other information about all sorts of things, about the labour market, about activity. We look at surveys. We talk directly to businesses. And those revisions are inevitable because the statisticians learn more over time about what's happened at a particular point in the past. And one has to recognise that and not treat a number as sort of God-given and fixed. And that applies also to the trade numbers and to other parts of the current account. The income balance often gets revised quite a bit as well. So I think you can say that the trend has been that the current account deficit has narrowed slightly. That's partly because the trade deficit has narrowed. The income balance has improved a little. But beyond that, I don't think one should make terribly precise statements. I don't know if you want to say anything else about that.
Okay, thank you very much for coming.